In colonial America, there were no banks. During the Revolution, the Continental Congress printed huge amounts of currency, which led to rampant inflation. Thanks to that inflation, the Continentals were practically worthless by the time the war ended. But soon after independence, banks were established, and Alexander Hamilton proposed a national bank.
A modern central bank does things like issuing a common currency, determining the money supply, regulating depository institutions, and acting as a lender of last resort for banks that are facing temporary cash shortages or when financial markets are disrupted.
It can also serve as a bank for its own government.
Alexander Hamilton, the first Secretary of the Treasury, and his followers believed the new country needed a national bank. Did everybody want one?
We've got to have a national bank, and a strong one too. Our country's destined to become a capital of commerce.
Spoken like a Yankee with a heavy purse, Ezra, my friend. Farming is the beating heart of this nation, and the bankers will squeeze that heart.
You're like a horse with blinders on. You can't see but what's right in front of you.
It will favor the speculators.
It will favor America, and all will prosper.
Too much power in too few hands, ripe for favoritism and corruption.
Alexander Hamilton championed the idea of a national bank in the United States.
Others in the young government, including Thomas Jefferson, who would later be president, were very much against a national bank.
Jefferson said that since the Constitution did not explicitly grant Congress the power to establish a national bank, such a bank would be unconstitutional. Hamilton had a looser interpretation of the Constitution.
Congress may do what is necessary to the end for which the Constitution was adopted, provided it is not repugnant to the natural rights of man, or to those which they have expressly reserved to themselves, or to the powers which are assigned to the states.
Hamilton and his supporters argued that there were some really solid reasons for establishing a national bank.
Like what?
Like, as a way for the federal government to finance its Revolutionary War debts, also to create a more uniform paper currency, and to expand the availability of credit nationwide.
In the end, Hamilton's interpretation of the Constitution won out. In 1791, George Washington signed the bill that created the Bank of the United States. The bank was chartered for 20 years. It opened in Philadelphia, then other branches opened in port cities. The bank was owned partly by the federal government and partly by private investors. It was by far the largest financial institution in the U.S. at the time.
This was the government's bank, or as many people say, the government's fiscal agent. It received the government's revenues, held its deposits, and made its payments. It was also a bank for the public, accepting deposits from and making loans to businesses and individuals.
Unlike modern central banks, the Bank of the United States did not officially set monetary policy, and it didn't regulate other banks. Yet, because the bank was big and had branches in several cities, it influenced the whole country's economy. In fact, it was so influential that a change in its lending policies affected the lending practices of state-chartered banks, and that affected the availability of credit nationwide.
Even after the first Bank of the United States had been around for 20 years, arguments over whether we should even have a national bank were still very much alive.
Congress was still evenly split on whether or not such a bank was needed, or even constitutional. And in 1811, the bank's charter failed to be renewed.
No more national bank, at least for a little while.
After the charter of the First Bank of the United States expired in 1811, what happened next?
You know what happened. Tell me.
With pleasure. The War of 1812 against Great Britain left the United States once again in debt. But we had no national bank, and that made the government's financial situation even more difficult. Some influential people thought a new national bank would stabilize our currency and help finance the war debt, but it still took years. Finally, in 1816, President Madison signed a bill authorizing the Second Bank of the United States.
So, how much are you looking to borrow?
Well, my new ironworks will be run entirely on water power.
The second bank operated much like the first bank. It had many branches, It was a banker to businesses and individuals. It was the federal government's fiscal agent, receiving its revenues, holding its deposits, and making its payments. It also helped finance westward expansion.
And then, in 1829, Andrew Jackson became president. Partly because of a bad financial experience he'd had, Jackson was on the side of those who opposed the bank. He withdrew the federal government's funds and transferred them to state-chartered banks.
Then, in 1836, the bank's charter expired. It was not renewed.
After that, the United States was without a central bank for more than 75 years.
Until after the Federal Reserve Act was passed in 1913. A full 3/4 of a century passed between the second bank's demise in 1836 and the passing of the Federal Reserve Act in 1913.
So what happened during all that time?
The United States didn't have a central bank, and that led to problems. For more than 25 years, there was no federal banking regulation at all. Banks were chartered by states, and in some of those states, legislators controlled who received charters to open banks. This led some unscrupulous people to bribe state legislators.
Why were they bribed?
To give certain people bank charters while barring others from getting them. In time, more than 15 states sought to remedy this influence peddling by passing free banking laws. These laws allowed anyone to open a bank, so long as they met some very minimal requirements.
But what about paper money? Who supplied that?
Well, throughout this period, banks, and sometimes even companies, issued their own banknotes. And some of these notes were very untrustworthy because of unsafe banking practices or even outright fraud.
You like the cow, eh? Cost you $10.
Fair price. 5, 6, 7.
Wait a minute. I've never seen those before. What bank are they from?
They're from Stormy Ridge Bank, as you can see.
Stormy Ridge Bank? I never heard of them.
In 1863, while the Civil War raged, Congress passed the National Banking Act. The law promoted nationally chartered banks, which could issue notes that were backed by U.S. Treasury securities.
The National Banking Act also established the Office of the Comptroller of the Currency. The OCC provided oversight of those national banks. Now, with a more uniform currency, a dollar from any of those banks could be trusted to be worth a dollar throughout the country.
The National Banking Act was passed during the Civil War, 50 years before there would be a Federal Reserve.
During those years, there was plenty of time to have some pretty serious financial crises.
This is outrageous, locking the doors on their customers.
I had my life savings in there. Or maybe they're not in there anymore. I heard they plumb run out of cash.
What have they done with our money? I don't understand.
In my opinion, those bankers are rascals. I don't trust them anymore to keep my money safe.
Several financial crises led up to the founding of the Federal Reserve. There had been a railroad building frenzy that collapsed and triggered multiple bank failures.
Sounds a lot like more recent financial bubbles.
Sure does. And that, and some other causes, led to a severe depression which began in 1893 and lasted for several years.
Just a few years later, in 1907, the Knickerbocker Trust Company in New York failed. That set off a cascade of bank failures, as well as a significant decrease in the money supply and a deep recession. Events
like the Depression of 1893 and the Panic of 1907 made it obvious that reform was needed.
So what happened?
Well, in 1908, Congress created a National Monetary Commission to study the economy, especially ways to reduce the number of crises and panics. The findings of this commission eventually led to the creation of the Federal Reserve System.
Which we can assume everyone was in favor of.
Not exactly. In 1912, a document known as the Glass-Willis Proposal recommended not a central bank, but privately controlled regional reserve banks. When Woodrow Wilson became president in 1913, he was against giving too much power to bankers and insisted on adding a public central board. After a lot of debate, this structure, which is both central-regional and public-private, was embodied in the Federal Reserve Act of 1913.
The Federal Reserve System was structured with a central part, the Federal Reserve Board in Washington, which provided oversight. It also included 12 regional reserve banks. This basic structure is the same today.
The distribution of reserve banks across the U.S. reflected the size of populations and the amount of commerce at the time. The Federal Reserve Bank of San Francisco covered a huge territory because the West was much more sparsely populated and less commercially active than, say, the territory of the Philadelphia Fed.
In larger areas, regional reserve banks opened branches to serve their districts better.
According to the Federal Reserve Act of 1913, one of the purposes of the Fed is to establish a more effective supervision of banking in the United States. Since 1913, the Fed has gradually taken on more authority to supervise and regulate financial institutions and activities. Among other things, the Fed tries to ensure that banks are financially sound and play by the rules.
The Fed is also the lender of last resort.
I like resorts. White Sands, scuba.
Not that kind of resort. A lender of last resort offers loans to sound financial institutions that are experiencing difficulties or are temporarily short on cash.
Why would the Fed do that?
The Fed might do it during a financial crisis or a national or regional emergency, especially if that institution's failure to get credit would have a severe negative impact on the economy.
Another rule the Federal Reserve has had from the beginning is its involvement in the U.S. payments system. From the outset, the Fed has provided a better way for moving funds around the country. For most of its history, the Fed operated a large nationwide network for clearing checks. In the electronic age, the Fed has been a leader in providing electronic payment services. It's also provided paper currency in the form of Federal Reserve notes, which became our main form of paper money.
So the Fed plays several roles and can influence the economy in different ways.
But its powers are limited, and we've definitely had some financial crises since it was founded in 1913.
And then came the Great Depression.
There have been several periods when millions of Americans couldn't find a job or lost their homes to foreclosure, but none, at least in the 20th century, were as bad as the Great Depression.
And during the Depression, the Fed did make some mistakes.
Sure did. But economists' knowledge at that time was more limited than it is today. In spite of bank runs, bank failures, and the economy being at a standstill, the Fed didn't do enough to provide liquidity to banks or to help the economy as a whole recover. Also, in the face of enormous unemployment, it allowed the money supply and availability of credit to shrink.
The Fed allowed prices actually to fall. There was a period of deflation where prices were falling very sharply, which turned out to be a very negative thing for the economy. About a third of all the banks, thousands of banks in the United States, failed. They collapsed, they went bankrupt. People lost their money because we didn't have deposit insurance protecting people's deposits in the banks. The banks were not available to make loans, and that collapse of the banking system was a major factor explaining why the Depression was as deep and as long as it was.
The Banking Act of 1933, known as the Glass-Steagall Act, passed during the Great Depression. It included a number of measures to protect bank depositors. One of these was the creation of the Federal Deposit Insurance Corporation, known as the FDIC. In the beginning, the FDIC insured bank deposits up to a limit of $2,500. Now, that limit is $250,000.
The Glass-Steagall Act also separated commercial banks from investment banks. Before this, banks could make potentially risky investments that could endanger deposits in the bank accounts of individuals and businesses.
The Banking Act of 1933 established the Federal Open Market Committee, or FOMC. The FOMC is responsible for setting the direction of monetary policy. It's also in charge of overseeing a part of monetary policy called open market operations. Open market operations are purchases and sales of U.S. Treasury and federal agency securities that are carried out to influence monetary and credit conditions in the economy.
No doubt about it, the Fed made mistakes during the Great Depression. But people in the Fed learned from those missteps.
That led to a Federal Reserve that has a better ability to keep banking and the economy running on a more even keel.
What makes a battle? This is what it takes to make a battle.
Among many other things wars do, they greatly stress the economy.
And World War II, which the United States entered in 1941, was no exception.
That war cost the U.S. about $4 trillion in today's dollars.
Supplies, equipment, weapons, made with one purpose and one purpose only.
To support the economic expansion needed for the war effort, the U.S. Treasury called on the Fed to help keep interest rates low. Through its monetary policy decisions and purchases of U.S. government securities, the Fed ensured that interest rates remained low. This meant it temporarily lost its independence in setting monetary policy.
After the war ended, interest rates stayed low for several years. By 1951, during the Korean War, the Federal Reserve wanted to fight inflation by pursuing an independent monetary policy. But the Treasury wanted to continue the low interest rates. After fierce debate, they came to an agreement known as the Treasury-Fed Accord. The agreement recognized the Fed's independence in setting monetary policy.
The Treasury-Fed Accord laid a foundation for the Fed's policy of aiming for low inflation and maximum employment.
Of course, since 1951, there have been some times when the Fed couldn't achieve low inflation and maximum employment.
Inflation occurs when the prices of goods and services across the economy go up.
When there's inflation at the same time as high unemployment and slow economic growth, do you know what that's called?
I do, but why don't you say it?
When there's inflation at the same time as high unemployment and slow economic growth, it's called stagflation.
In the 1970s, monetary policy was too loose. The money supply was growing faster than the economy, and that led to inflation. People started to expect inflation, and they built this expectation into their economic decisions. That led to even more inflation. High inflation, plus other shocks to the economy, like a quadrupling of oil prices, led to a bad recession with periods of high unemployment. In other words, stagflation.
In 1979, Paul Volcker became chairman of the Federal Reserve. Soon after he took office, the Fed raised the federal funds rate a lot. This is the rate at which banks lend to each other. The increase was painful, but after a while, it brought inflation down.
The U.S. faced nearly double-digit inflation for quite a while. It rose from 2 or 3% inflation in the late 60s, rose up to 4%, then to 6%, then to 8%, then to 10%. People thought that the cause of the inflation was oil prices, but in fact, it was monetary policy. We kept trying to lower the unemployment rate because that was part of our mandate. But in fact, all we ended up doing was raising the inflation rate.
The ascendancy of Paul Volcker to the Fed chairmanship really changed this situation. Volcker was determined to clamp down on inflation, which he did.
One law that came out of the period of stagflation was the Humphrey-Hawkins Act of 1978. It required the Federal Reserve to give Congress reports on its goals and policies twice a year. That law has expired, but the Federal Reserve still reports to Congress very regularly on a wide range of issues, including monetary policy.
The Federal Reserve ranks among the most transparent of central banks. We publish a summary of our balance sheet every week. Our financial statements are audited annually by an outside auditor and made public. Every security we hold is listed on the website of the Federal Reserve Bank of New York. And in conformance with the Dodd-Frank Act, transactions-level data on all of our lending, including the identity of borrowers and the amounts borrowed, are published with a 2-year lag.
Remember, though the Fed regularly reports to and is accountable to Congress, the Fed's policies and practices are independent.
That independence is important, both in boom times and when the economy hits a rough patch.
And why is it so important?
Because it ensures that monetary policy is conducted without influence from politics.
Evidence clearly shows that when the central bank is independent from political forces, it tends to make good long-term decisions. Because the decisions that monetary policy makers make have long gestation periods. They take a long time, longer than a politician is often willing to wait for.
The 1980s and 1990s were a time of deregulation.
Which means exactly what it sounds like. The government ended some financial regulations that had been around for a long time.
For instance,
banks had been restricted as to the amount of interest they could pay on deposits. Now, those restrictions were lifted. Also, they could open branches in other states. The Depository Institutions Deregulation and Monetary Control Act of 1980 required the Fed to provide discount window loans, as well as check clearing and other payment services, to all depository institutions, not just those banks that were members of the Federal Reserve. The Fed had to charge for those services and compete in the market with other firms that provide those services. The Act also required all depository institutions above a certain size to hold money in reserve accounts at the Fed.
The same period also saw the repeal of the law that had separated commercial banking from investment banking and insurance activities. And in the last couple of decades, the Fed's payments system has been transformed by technology.
So, a lot of money doesn't always move around exactly the way it used to.
People now make many more payments electronically. One effect of this is that people use many fewer checks. So the Fed has significantly shrunk its check clearing operations.
New technologies are also incorporated into our paper currency, with security features that are easy to use, but hard to counterfeit.
The Fed, the U.S. Treasury, and the U.S. Secret Service work together to redesign Federal Reserve notes with security features such as color shifting ink and embedded security threads.
The Fed uses technology to increase efficiency and to avoid problems that may arise in our nation's payments system.
Our mission remains the same. Our dual mandate of stable prices and low unemployment, and making sure that the financial system is safe and sound. However, how we do that is constantly changing because our world is constantly changing due to a variety of forces, most notably technology. The Fed has embraced technology in a major way to become more efficient and more effective in delivering on its mission.
In 2007, a financial crisis began that was the worst since the Great Depression.
Among other things, a housing bubble burst, many home loans were in default, and a number of major financial firms either failed or were saved only by government intervention.
Well, the financial crisis of 2008 and early 2009 was certainly the worst financial crisis since the Great Depression, and by some measures probably even worse than the Great Depression. So the Federal Reserve took a lot of actions to try to stabilize the financial system that involved short-term lending to financial institutions to allow them to remain open and allow them to remain solvent. And beyond that, we took a lot of actions to try to make sure that the critical financial markets were also functioning.
The Federal Reserve also dropped interest rates to very low levels to ensure that credit could continue to flow across parts of the country when confidence was really eroded at that time. It's one of the essential roles of a central bank to make sure that liquidity is there in a time of crisis, to make sure that financial institutions were able to get access to funding so that they could continue to make loans and to meet their obligations in the regions.
The financial crisis revealed some critical gaps and weaknesses in financial regulation. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010, dealt with a number of these weaknesses.
Dodd-Frank created the Financial Stability Oversight Council, which monitors risk in the overall financial system. The Federal Reserve is a member of this council.
The act also expanded the Fed's supervisory responsibilities to include savings and loan holding companies. They also include some non-bank financial firms and payment, clearing, and settlement utilities.
And the Act requires the Federal Reserve and other supervisory agencies to supervise financial institutions and critical infrastructures, with an eye toward the safety and soundness of each individual firm and risks to overall financial stability.
Dodd-Frank transferred many of the Federal Reserve's responsibilities and those of other agencies for consumer protection to the newly formed Consumer Financial Protection Bureau.
The Dodd-Frank Act also modified the Fed's ability to give emergency loans to individual companies during financial crises. It requires the Fed to make such loans only when they're made available broadly, not just to specific firms.
The Fed and other agencies were there to do what they could to stabilize the economy.
But economies are very complex. The crisis was severe and long-lasting, and it showed once again that there are no magic bullets to quickly fix an ailing economy.